This week's episode of The Financial Edge is brought to you by Hoffman Financial Group. Come build your financial dynasty.
Welcome to The Financial Edge. I'm Erin Kennedy. High interest rates mean good news for annuity buyers, but should you buy one? Today's guest, Chris Hoffman. Chris is the founder of Hoffman Financial Group, an Atlanta area firm that focuses on preparing people for a successful and happy retirement. Chris is also the popular radio show host of Money Unleashed, and Hoffman Financial Group is the official partner of the Georgia Bulldogs. Chris, it's so good to see you again.
Good to see you. Great to be back.
Yeah, well, annuities, we have to talk about it because sales set new records in 2024. The trend continues for 2025.
Right.
Listen to these numbers. It's expected that they will exceed $520 billion.
That's a lot of money.
So they're popular. Why this love-hate relationship with them?
Yeah, so there are many types of them, and I think that's where people get confused, and they may rush into buying the product and then find out, oh, that wasn't the right one for me. So you do have to research the various options. You need to meet with somebody that holds your individual best interest at heart. Then they find the right annuity type for you. And annuities are not for everybody. So look at them, do not rush into purchasing them, and understand the different types. And I think that would help you to make the right choice for you and your family.
And before we get into the different types, I do want to ask about interest rates. They've been high. That makes them more attractive. They may come down, though. So is now still a good time to be buying one?
Yeah, it is. There's really two ways you can purchase annuity and benefit from it. The first one is a fixed interest rate. So as interest rates rise, you can get a fixed annuity that will pay you a fixed interest rate. So those prices will go up. As interest rates come down, naturally, those interest rates get lower. But they can also be used as bond replacements to some extent. So you can index against the market and you don't have to worry about the current interest rate environment, whether it's up or down. You can basically invest a little bit of that money in the stock market per se through an index, and you can take advantage of growth through that.
Yeah, I hear you say fixed income, and that's what this is all about, right? Creating stable income in retirement. How do annuities play a role in that?
Yeah, they play a big role, especially since in the 80s we did away with pensions, corporate pensions for the most part. So very few people have pensions that pay a large amount. So we're looking for that guaranteed income or highly reliable income. Today, the only guaranteed income we have typically is Social Security. And obviously there's a lot of questions surrounding the viability of Social Security moving forward. So adding an income annuity, which is a guarantee from an insurance company to pay you an income stream every month for the rest of your life, provides comfort in retirement for my retired clients.
Right, and there are studies that show that when you have that guaranteed income, retirees are happier.
Yeah, I mean, you want to put your head on the pillow at night and not worry about what's going on the international markets or in the stock market or in the economy. You can basically wall yourself off and say, if all else fails, I've got this income stream coming in. I have Social Security payments. I have my income annuity that will pay me, and it will repeat and fill up my checking account or savings account month over month for the rest of my life. That's a powerful thing. It doesn't matter if you live until 120 years old. The insurance company is obligated to pay you that amount for the rest of your life.
Yeah, getting rid of that longevity risk.
That's right.
I think my grandma called it mailbox money.
Yeah, that's good. I like it. Or cupboard money.
Okay. So now, Chris, take your time and walk me through the different kinds of annuities, because this can be overwhelming to somebody who's not familiar with it.
Yeah, so let's boil it down to three classifications of annuities. The first one would be a fixed annuity that pays an interest rate guaranteed over a period of time. You can buy a 3-year fixed annuity or a 5-year fixed annuity or a 7-year fixed annuity, and they're obligated to pay you that interest rate for all of those years. Safe, right? Because we get a guaranteed payment.
Right.
It's not dependent on stock market growth and isn't subject to any stock market loss. So you're protected against any loss, and you have a guarantee from the insurance company to pay you that interest rate. So that's a fixed annuity.
Okay.
The second annuity would be an indexed annuity. An indexed annuity, you link your potential growth to an index. So something as simple as the S&P 500. Now, you won't get all of the S&P 500 growth. They will have caps. So you might get capped at a certain percentage that you can make on the S&P. Or you have a participation rate. You might get a percentage payment on whatever the S&P 500 does. That all sounds good, but why would they cap me or only give me a lower percentage than 100%? The reason is because you have downside protection. If the market goes down or the index loses value, the insurance company will not take any money away from you. So that's a powerful way to play the market. The third option is a variable annuity. That does ride the market up, does ride the market down. So you need to understand there is a risk to your principal investment. You could lose money in a variable annuity. Variable annuities also have traditionally high fees. So you're going to want to talk to your financial advisor about exactly what the fees are. And there are 3 layers of fees. So make sure if you talk to somebody and they say this is a variable annuity, you ask, well, give me the 3 layers of fees inside of the annuity, and I want to know exactly what I'm paying for, and then I want to understand my upside potential. Variable annuities also have a guaranteed income stream. If you buy that rider, that's going to cost you money too. So watch the fees on variable annuities, but those on occasion can be powerful for folks as well.
So then how are you helping clients determine what's best for them?
So we listen twice as hard as we speak, and we really want to find out what that individual or that family needs are. Do they want the maximum guaranteed payment per month for the rest of their life, and they don't care about losing that principal and eating it up, and they don't have a legacy plan for that bucket of money? That's a maximum payment in their lifetime. Or if they want to see that money grow and they don't necessarily need it or need all of it in their lifetime and want to spend all of it in their lifetime, we can find good, solid growth potential annuities for them. So it's a matter of the individual couple or the individual themselves and what their needs and requirements are. So it takes some due diligence on the investment advisor's part to figure out which one fits you best, if at all. You may not even want one of those 3. So it's really an individualized study that we do.
And if your advisor can't answer those questions about fee transparency or anything else, then
find
just
another
walk
advisor.
away. Find another advisor. Chris, thank you so much for this conversation. I'm glad we got to break this down, because the time to act is now. For you at home, if you would like to learn more about how annuities can provide you with guaranteed income in retirement, Chris has a great offer. For the first 5 callers with a portfolio of $500,000 or greater, Chris is offering a complimentary personalized retirement plan just for you. This will allow Chris and his entire team to sit down with you personally and provide you with that roadmap, analyzing where you are right now and discuss your next best steps to get you ready for a successful retirement. The number, you can see it right there on your screen. It is 678-658-3151. And just to say that number one more time, please call 678-658-3151.
Memories with Grandpa.
My first job.
My 4th job.
Crazy road trips.
Our first date. Meeting our son.
Exploring our world.
Our world. Family and friends.
Our special song.
Secure your retirement by meeting with a financial advisor.
Call now Chris Hoffman and the team at Hoffman Financial Group, 678-658-3151, 678-658-3151.
At Hoffman Financial Group, we're always trying to improve our skill set. That's why we're here in Athens, working with some of the best around. We may not be SEC ready, but there's nobody better to build your financial dynasty than Hoffman Financial Group.
Welcome to the Financial Edge. I'm Erin Kennedy with Chris Hoffman today. Thanks for being with us. Can you afford a financial advisor? When is the right time to hire one? Today we're going to discuss it all with Chris. As you know, Chris is the founder of Hoffman Financial Group, an Atlanta area firm that focuses on preparing people for a successful and happy retirement. Chris is also the popular radio show host of Money Unleashed, and Hoffman Financial Group is the official partner of the Georgia Bulldogs. Chris, I'm really excited about today's discussion. I'm sure you get it a lot.
How much time do we have?
I know.
This is a big one.
This is a big one.
Yeah.
And before we get into it, I want to share some stats with you. A recent study from Charles Schwab found only 1 in 4 Americans has a financial plan. The top roadblock to planning, most people think that they don't have enough money to need a formal plan. So who needs a financial plan?
Yeah, so everybody needs a financial plan if you're going to retire. Call it a retirement plan or call it a financial plan. In your 20s, 30s, and 40s, you're trying to amass your wealth. It's simple index investing, if you would, S&P 500, NASDAQ. But when you look at your statement and you say, this is a material amount of money to me, doesn't matter whether that is $100,000 or $10 million. If you would lose 10 or 20% or 30% of it, would you say, oh, wow, this hurts? That's the time to start to consider working with a financial advisor to build out a more holistic plan for you. That plan needs to add 2 things. Obviously, everybody's focused on growth. We want to invest our money, we want it to go up, not down.
Right.
But when you get closer to retirement, and I would say you start targeting this around mid-50s in age, if you've got a target date for retirement and you're getting into your late 50s, you've got to add 2 things to your financial planning and investment strategy. One is you got to start looking at how much do my investments have the ability to send me an income, and what are the taxes on that distribution? And the second thing you need to add is some level of understanding what protection is included in my portfolio. And that's standard deviation. It's a measure of financial risk. So you have growth targets, income plan with taxes, and you need a protection strategy. And that's the way you glide yourself into a comfortable and less stressful retirement.
Okay, one more number from that poll. 20% said they don't know how to get started. So if you can break it down for us, what steps should I take and what is expected when I make that first phone call?
Yeah, so that's the key. The biggest hesitation, and even with our show and my radio show, people will call and say, I've been watching you for years, Chris, and now I'm finally ready. So there is a timing, and you have to be comfortable that you're ready for it. But we will break it down into very bite-sized, edible steps for you. The first step is to call or go online and sign up for a portfolio x-ray.
Okay.
When you call, you can book an appointment. Somebody will call you back Monday or Tuesday. And the portfolio x-ray is a analysis of what you have today. It breaks down everything. It breaks down the fee structure. It breaks down your growth targets and achievements. It'll break down your risk profile and what would happen if we went through another Great Recession or COVID crisis. How much damage would your portfolio go through? That gives us the foundation of whether we need to make changes or you're in good shape, and we can then begin the planning process. So that's the first step. It's very easy. From there, we can go into developing an income plan for you with tax strategies, and then we wrap it all in a nice bow in a full financial plan from today's age through age 100.
Right. And there might be some people who are at home saying, you know, maybe I'm okay, and they just want a second opinion. Maybe they come into you and they get the portfolio x-ray, and they find out maybe they are on track. That must be empowering for them.
Yeah, it's rare that we're not able to show them 2 or 3 what I call golden nuggets of things that they didn't realize were happening in the portfolio that are either stalling their growth or exposing them to too much risk. Now, that doesn't mean if we find 2 or 3 golden nuggets in their portfolio mix that they need to hire us as their advisory team. We can actually make a recommendation on things like 401k optimization and repick from that list. So people shouldn't feel like meeting with a financial advisor, you're automatically saying, I'm going to hire you. That should not be the case. So I would encourage people to call, get the 401k x-ray from us, digest it, take your time, and then determine, do you want to continue with a income plan and a full retirement plan?
A lot of people also assumed it would be too expensive to work with an advisor. They probably don't realize whether it's worth it or not to them, right? So a financial plan, though, isn't necessarily just for the ultra rich.
No, so the fees that a financial advisor charges, 401ks, they hide them. And I believe they're not disclosed properly. So that's a big question mark that people have is, how much are they charging me in my 401k? But a financial advisory fee is a specific fixed percent. But that advisor should take it to another level and basically once a year, let's say at the beginning of the new year, should sit down with their client and say, here's how much you paid me last year. Has anybody out there who's watching today who has a financial advisor had their financial advisor say to them, hey, by the way, you paid me $15,000 last year, and then back it up with, here's how I benefited you exponentially more than $15,000. Here's how much in tax savings I provided to you. Here's how much I beat the benchmark of the market and made you. And here's how I protected you in a down market and you didn't lose anywhere near what the market lost last year. If they can't justify that, you don't need them as your advisor because they should get a fee based on exponential success in your portfolio and in your financial plan. And they should be able to have an open and honest conversation with you at least annually on that.
I call that accountability.
That's right.
Yeah. So I believe, you know that every client is unique. There is no cookie cutter answer, as much as we would all wish there was one number we could all strive for. There isn't. But that's why you and your team are fiduciary investment advisors, not brokers. Can you explain the difference?
Yeah, so let me go back in time quickly. For years, all financial advisors and or brokers back in the day got a Series 7. That was a brokerage license that allowed you to charge commission. So what happened was brokers were calling their clients almost daily saying, sell this stock, buy this stock, and they would get paid on selling it and on buying it. So the way they made their income, they could dictate how much they made monthly or annually by the number of phone calls and transactions that they put their clients through. That's called churning. So the industry woke up and said, wait. How about instead of commissions, we do an advisory fee? So a common advisory fee would be they charge 1% on your assets per year. But now you run the risk of your financial advisor not calling you and not engaging in meetings because they're getting paid no matter what. So just understand, if you're going to hire a fiduciary financial advisor, that's great. Fee-only advisor would be great. But you're going to have to make sure and ask them, how many meetings am I going to be offered per year? We offer our clients 4 meetings, once a quarter. They can take us up on that. They get notified. They can book it themselves. But if they're not willing to meet with you at least 2 or 3 times a year, they're collecting a fee and they may not be paying attention to your portfolio. So now, the fee-based advisors have a fiduciary designation, which means you need to act in the utmost best interest of your client. I think that's powerful as well.
Interesting. I'm glad we got to talk that through. If you are at home right now and you'd like to learn whether you are on track, just call the number you see on your screen right there, 678-658-3151. That will allow Chris and his team to give you a personalized retirement plan or even just a second opinion on the plan you already have. Call 678-658-3151, 678-658-3151.
As you prepare your clients for retirement, you'll see that the margin for error is so small. Our clients work their full lives to get here, and that's why you must dig deep, plan smarter, and push ourselves out of our comfort zone. Let's go get them, team! Oh, Harry, just giving the team a pep talk. When it comes to the pregame speech, we trust the coaches to get it done for the dogs. When it comes to building your financial dynasty, there's nobody better than the Hoffman Financial Group.
Do you know what that sound is? It's me traveling the world, Europe to Asia. I'm vacationing and living the retirement of my dreams. Because I just met with a local trusted advisor. They helped me turn my nest egg into a golden egg.
Call now Chris Hoffman and the team at Hoffman Financial Group, 678-658-3151.
Welcome to the Financial Edge. I'm Erin Kennedy. Hoping to retire this year? 5 money moves to make before you retire. Today's guest, Chris Hoffman. Chris is the founder of Hoffman Financial Group, an Atlanta area firm that focuses on preparing people for a successful and happy retirement. Chris is also the popular radio show host of Money Unleashed, and Hoffman Financial Group is the official partner of the Georgia Bulldogs. Chris, good to see you.
Good to see you.
You know, planning for retirement, it should take place over decades, maybe years.
Yes.
It should. We're all looking forward to it.
That's right.
But it does take some planning.
It does.
So we have 5 questions that we need to walk through before you retire.
That's right.
And the first one, maybe one of the most important financial decisions you'll make, when to claim Social Security.
Yeah, so Social Security will pay you over $1 million in your lifetime, and we want to maximize that payment. So you've got to determine whether you trigger it early or at full retirement age, or you defer until 70, which is your max amount. It's very individualized. So I encourage anybody who calls, we would run a Social Security analysis for them. And in that analysis, we can give you 3 or 4 varying options. It will also have an optimal strategy in there. So it depends. It depends on age difference of spouses could be a contributing factor to when to trigger Social Security. Do both spouses have an equal level of Social Security? And then it's a matter of looking at your investable assets and how much income you can generate from those to dictate whether you need Social Security to not damage your portfolio and draw it down, or whether you can defer and get those automatic increases over time and use investable assets, or some folks have idle cash that you can use to get to a full retirement age.
Right. So let's walk people through, because we have a visual that we want to show them about the detriments of kind of claiming early, how that means a lifetime of reduced benefits.
Yeah. So if you trigger between 62 and 67 or before 67, your full retirement amount, you also have to be conscious of the fact that you may be in a penalty box. If you make too much income, if you're not fully retired, they can start taking away dollars of your Social Security and you're collecting it. Keep in mind that Social Security is also taxable, so that needs to be built into your plan as well. But at age 67, no more penalties, but you're still exposed to taxes, and then obviously you can defer all the way up to 70, and that's your max amount. You've got to turn it on at 70, otherwise you're giving the government your money.
Don't do that.
Yeah.
All right, next, determine whether you have adequate savings. But how do we know?
Right, and that's kind of a misnomer, I believe, in the financial services industry. A lot of large box firms or investment firms will talk about the magic number.
Right.
Do you need $1 million to retire? 1.5. I recently saw a report that said you need $1.9 million. That's, to a large extent, that's the wrong number to look at. You've got to look at how much your financial life can pay you in retirement. It needs to generate your paycheck. So all of your financial resources, Social Security, pensions, dividends, fixed income, that becomes your income stream in retirement.
Yeah.
So that's the important number. It's not that the total value of your assets isn't important, but if you could replace your paycheck with monthly income from all of your financial assets, you basically are getting paid like you're going to work, but you don't have to go to work. That sounds like a pretty good deal to me, so that's what we shoot for at Hoffman Financial Group.
I would take that deal.
Yep.
All right, next, decide on a withdrawal strategy. We've heard of the 4% rule. I know you're not a big fan.
Not at all.
I've heard you tap your buckets in a certain order.
Yep.
Usually it's tax deferred, then taxable, then tax-free. We can show people that order. What do we need to keep in mind when we're thinking this through?
Yeah, so let's talk about the cardinal sin, which is telling your financial advisor, send me 5% of my assets annually, or send me $5,000 a month or $10,000 a month. That may cause your financial advisor to sell out of positions in your portfolio at the wrong time. Nobody would want to sell stocks when they're down unless they're not good stocks. You would want to shave off gains when the market is going up. More so than picking a percentage or telling your financial advisor, send me an exact amount, an equal amount monthly, put that onus on your financial advisor and basically tell them, design an income plan and tell me how much you can generate an income for me without invading my principal. Because you want to use your principal for the fun stuff, you want to use the growth of your principal for fun stuff, and or you want to leave it as a legacy. So when we look at the withdrawal strategy, you should have 3 buckets of money. You should have tax deferred. I think everybody's familiar with that. The 401ks that were created in the 80s, we pay into them. We do not pay taxes on those contributions until we take the money out, and it's taxable back to $1. Unfortunately, it's taxable as income, which is the worst tax. Why do I say that? Because it's unpredictable. We don't know where taxes are going to be in 5 or 10 or 20 years. So you should balance that bucket with taxable money It's called non-qualified. It's non-qualified through the IRS to qualify as a retirement bucket, but you pay just on the growth when you achieve it. You can have unrealized gains in a taxable account that you don't pay taxes on annually. You only pay on it when you sell it. You can generate dividends for income from it. It's also a valuable bucket to have if you're going to leave money to your children, because they will get a stepped up cost basis on their stock portfolio or your stock portfolio that they inherit. So it can be very powerful from a tax standpoint. The best bucket of all is the Roth bucket. That's the tax-free bucket that we have no restrictions, no requirements to draw down. When we use that money, we don't have to pay any taxes on it, and we can leave that to multiple generations, kids, grandkids, etc., and they're not required to take that money out, but it's a tax-free benefit for them. Typically, the way I look at this strategy is if you can have a third, that's optimal. Very rare to see that. Most people have all or a large majority of their money in tax deferred. We can work with them on how to transition it to taxable and Roth accounts.
And the next would be to schedule check-ins. Make sure that you're on track. But how often do you think people are doing this?
Well, at Hoffman Financial Group, we make it mandatory that every one of our clients gets a quarterly text, and they're able to book their appointment online. They can book it as a Zoom meeting, or they can come to one of our 7 offices. But it's important to meet with your financial advisor, we believe, 4 times a year, even if it's just a check-in for 15 or 20 minutes. For us to give you the scorecard on how we've done for the quarter, talk about what we're seeing for the remainder of the year, and just basically find out what's going on in your life and what your potential needs are. They may have changed over the last 3 months. So we want to stay in close contact with our clients.
And last, quickly, even though it's very important, consult an advisor.
Yeah, you need an advisor. You need that second set of eyes, second set of ears. And if you're married, now you've got a team of 3. So very powerful. Definitely interview several financial advisors before you choose one, but choosing one nearing retirement is important.
Yeah, you only get one chance to do it right. Chris, thank you so much. If you'd like to figure out if you're ready to retire this year, next year, or tomorrow, give Chris and his team a call. Chris has a great offer for the first 5 callers. With a portfolio of $500,000 or greater, Chris is offering a complimentary personalized retirement plan just for you. This will allow Chris and his team to sit down with you personally and provide you with a roadmap analyzing where you are right now and discuss your best next steps to get ready for a successful retirement. The number to call is 678-658-3151. Again, the number is 678-658-3151.
If you have questions about your retirement, if you're uncertain about your financial future, or if you simply want a comprehensive plan that covers all the essential aspects, we're offering you a chance to connect. Our team has been serving our community for years, and we've identified the critical elements that often go unnoticed in retirement planning. Give us a call at 678-658-3151, and we'll schedule a free review tailored to your needs. We'll discuss your goals, assess your risk tolerance, and examine crucial factors like fees, taxes, and income planning. Together, we'll craft a strategy that ensures your financial well-being. Take control of your financial future and gain the confidence you deserve.